Academy, and I want to welcome everyone to this channel. Okay, if this is your first time of coming across this channel, please do well to subscribe, turn on the notification bell to get notified once we upload weekly content. Okay, we upload our content on a weekly basis. Okay, so I picked up something during the week and I wanted to share it with us. Okay, so uh, we are going to be talking about trading plan money management. Okay, so this lesson is going to be more like a math. It's going to be more like a mathematical. Okay, there's not going to be charts or any stuff like that. Okay, it's just going to be pure maths and the rest. So what I'm going to do right now, I promised to make to create a weekly outlook on some pairs. Okay, I'm going to work on that after this video. Okay, so you might want to watch out for that as well. Okay, that will be me sharing my thoughts, my opinion on different currency pairs. Okay, that will be me sharing it with the community. Okay, so let's get started to this video. All right, now taking a close look at this um, little kind of table right here. Okay, so trading plan money management. Okay, so I wanted to do it. I felt the need to create a trading plan money management. Okay, and I actually worked on it today. I've been working on it all day and I found it maybe it might be useful, and but the thing is that you don't have to take my word for it. You just have to make your own research, and not everything here are accurate, though, because the market do fluctuate and price tends to change. Okay, so but I'm just going to share this with us and I hope every one of us find it helpful. Okay, so now trading plan money management. Okay, so let's say this the column right here, as you can see, is your account capital. Okay, your account size. Okay, we have the one of $20 capital, $50 capital, $100 capital, $200 capital. Okay, so but it's not more like, I'm not advising you to start trading with $20. Okay, at least it should be a minimum of 100 or 50, but I just included it just in case. Okay, so now if, let's say for example, you have a $20 capital account. Okay, so now what the next column we are seeing here right now is the risk per trade in percent. Okay, so you will not be having a low account actually increases your risk per trade. This is because if you decide to reduce the risk, like you decide to reduce your lot sizes, because the risk comes with the increment in lot sizes and the rest. Okay, using the lowest lot sizes for these kinds of accounts will not be helpful, and the money and what you are going to actually get from it is going to be very very little. Okay, so this is one of the disadvantages of having a small account. Okay, once you have a small account, your risk tends to go higher. Okay, so now in this case, someone let's say you have a $20 account. Okay, your risk per trade will be between 10% to 20% of your capital. Okay, your risk per trade will be between 10 to 20%. Okay, in other words, you are not going to risk per trade you are taking, you are not going to risk more than 20% of your initial capital right here. Okay, so even though you have multiple positions, your drawdowns should not be more than 20% of the capital. Okay, same goes here. If you're having a $50 account, your risk per trade is going to be between 10% to 15% of your capital. Okay, just look at that. As you can see here, when our capital increased and our risk per trade decreased, you see, So I hope you are getting the advantages now. So now, having $100 account, your risk per trade should be between 1% to 10% of this capital of the $100 of your initial capital. Okay, this, I'm not kind of advising you right now. I'm just sharing my opinion. Okay, I'm not a financial advisor, neither am I registered to give you any financial uh, opinions. Okay, I'm just sharing my own thoughts, and this is what I would do if I have one of these accounts. Okay, this is how I'm going to manage the account. That is just what I'm sharing with us. Okay, so now, if you're having, let's say I have a $200 capital. Okay, my risk per trade is going to be around 1 to 10% of the $200. Okay, so I hope we have gotten these two columns here clear. Okay, now your risk to reward ratio, the minimum trades risk to reward ratio you are going to implement is 2 to 1. Okay, it's 2 to 1. In other words, if you are risking 10% of your uh, your initial capital, you should be expecting 20% return. Okay, so you are risking 2 for 1. You're risking 2 for 1. Okay, so same goes here. If you are risking 10% of this, you should be expecting back 20%. Okay, so you are risking 2 for 1. So the minimum setup, the minimum kind of setup you are going to be placing, the orders you are going to be placing should have at least a movement of 2 times your risk. Okay, a movement of 2 times your risk. That is what the risk to reward ratio means. Okay, so we are using a minimum of 2 to 1. Okay, you can have 5 to 1, you can have 10 to 1, you can have as much as possible returns on each trade you place, but the minimum here is the minimum advice I advise rather should be 2 to 1. Okay, should be 2 to 1. All right, so now fixed stop loss. Okay, so in other words, I fixed a set on this trading plan money management. I built it around a fixed stop loss, uh, in other words, each trade you are going to place, let's assume you are using a 20 pip stop loss. Okay, you are using a 20 pip stop loss. Trust me, I haven't even used up to 20 pip stop loss once, but I'm just saying this for an example. Your stop loss could be lower than that. It could be 10, it could be 5. Okay, but I'm just assuming that the maximum stop loss you are having is 20 pips. Okay, that's the fixed stop loss we are going to be using throughout this trading plan money management series. Okay, so now your daily drawdown is 20%. Is 20% of your capital. Okay, in other words, the total amount of money you are expected to lose on a daily basis. Okay, the total losses you should take on a daily basis should not be more than 20% of your initial capital. Once you exceed 20%, once you reach the 20% limit, you are done for the day. Okay, if you are in losses or in profit, you are done for the day. If you are in losses, you should just cut your loss and close trading for that day, or you can switch over to demo. Okay, so now the minimum lot size you are allowed to use on a $20 account is actually 0.01 is the minimum. Okay, so this is the minimum and this is the maximum lot size. You are not allowed to use more than 0.2 lot size. Okay, you are not allowed to use more than 0.2 lot size. Okay, now the risk per trade in value, in other words, this is the risk per trade in percentage. Okay, you are not supposed to risk more than 10 to 20%, and 20%, which is the maximum. Okay, the risk per trade in value right here is represent the maximum, which is the higher number. Okay, which is the 20%. So the 20% of $20 account is $4. Okay, 20% of it is $4. Okay, so now when I referred to the risk to reward ratio, this was what I mean. So your profit targets will be $8. Okay, so in other words, you are risking $4 per trade you are taking and expecting to make a minimum, or you are expecting to make at least 2 times your risk. Okay, 2 times your, so in other words, you are expecting to make back twice your initial risk. Okay, so this will be your take profit will be not exactly, I don't mean you should collapse the trade at $8. Is you can have more, risk to reward ratio, but the minimum you are allowed to take, the minimum kind of entries you are allowed to take should have at least, should be able to give back eight dollar. Okay, so depends on your on the trade you are on, the setup you are looking at. Okay, it depends on the setup you are looking at. All right, so that is just that for that. And we have the $50 right here. So our risk per trade is between 10 to 15% of $50. Okay, minimum of 2 risk to reward ratio, fee stop loss of 20 pips. So our daily drawdown should be not more than 50% of this. Okay, so our minimum lot size, you can just go through it. Okay, you can pause the video and go through it. If taking a look at this, you will notice that the higher your capital grows, the lower the risk per trade decrease. Okay, so the size of your capital actually determines the kind of risk your account is going to be taking. Okay, it's going to be undertaking. All right, so we have a $500 account here. Risk per trade is between 1% to 5% of $500. Okay, fee stop loss of 20 pips. Our daily drawdown should not be more than 5%. Okay, minimum, and the maximum lot size you have to use on a $500 account should be 0.14. Okay, risk per trade in value, that would be around $25. You are risking $25 to make back $50. Okay, you are risking $25 to make back $50 because I'm using the 5%. The 5% of $500 that you are risking per trade in value is equivalent to $25. Okay, so when you have a $1,000 account, your risk ratio should be 1 to 4%. Okay, your daily drawdown 4% minimum, and the maximum is, you can just go through it and you can just see it is here. Okay, if you have a $100,000 account, your risk per trade should be not more than 1%. Okay, 20 pips, daily drawdown 1%, 0.1, and your highest loss size should be not less than 5.65%. Okay, so now the purpose of this is actually, I'm not really forcing it on you, I'm just kind of sharing my opinion, because this sound money management is very essential in trading. Okay, so sound money management is very essential. So you can actually put this out on the demo. You can place it out on the demo, try it out on the demo, just play around with it and see how the result plays out. Okay, you can just try it on the demo account and see how it plays out. Okay, so now going to our next slide right here, I'm going to show us how to calculate the value of a pip per dollar. Okay, I'm going to show us, and I'm going to be really quick, I'm going to be talking fast, and the video is kind of, I don't want it to be too long. Okay, so using the formula, in order to calculate the value of a pip per dollar, we use the decimal place multiplied by the lot size, divide by the current market price. Okay, so we have the types of lot size. We have the micro lot size, which is 1000 units of the base currency. Okay, so now in your MT4 or whatever platform you are using, you are going to the micro lot size consists of the 0.01 to 0.09. In other words, 0.01 means you are buying the 1000 units of the base currency. Okay, and 0.09 means you are buying 9000 units of the the base currency. Okay, so if it is 0.02, that will be plus 1000, that will be 2000. If it is 0.03, that will be 3000. If it is 0.04, that will be 4000, and so on until we get to 9. Okay, this is where the micro lot size stops. Okay, so anything between 0.01 to 0.09 is a micro lot size. Okay, now the mini lot size is the mini lot size, that's 10,000 units of the base currency. Okay, example, when you place an order of 0.010, that is 10,000 units of the base currency you just bought. Okay, so between 0.010 to 0.099, okay, that is a mini lot size. Okay, so if it is 0.011, that will be 11,000 Okay, in other words, we have when it is 11, when this figure is 11, okay, whatever figure that is on the last side is a micro, so we add the value of the macro to the value of the mini lot size unit. So what I mean is that if we have 11 right here, if this was, for example, this is 0.011, okay, and when we get to the calculation, you understand what I'm trying to say. So let's assume you have 0.011 here, okay. The lot size, the units, how do you calculate the units? Okay, what you are going to actually do is that the value here will be equivalent to 10,000. Okay, so if this was 2, that would be 20,000. Okay, so whatever value that appears on this other side is going to be on the units. Okay, so in other words, what I'm trying to say right now is that once you have 0.010, what you are going to do is that you add 10,000 plus the figure here. Okay, if it's 0.012, that would be the macro, so that is macro, and you add the value of the 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 mini and the micro together. Okay, in other words, you add 10,000 to 1,000 units, so that giving us 11,000 units. Okay, so if you are buying 0.011, you are actually buying 11,000 units, because that would be 10,000, which represent this one, and 1,000, which stands for the micro. Okay, so any figure on this other side belongs to the micro, lot size, while the single finger on this other side belongs to the mini lot size. Okay, so between 0.9 to 0.10 to 0.99, that's mini lot size. Okay, so when this, for example, this will be kind of almost close to 100. This will be 99,000 units. Okay, this will be 99,000 units. Okay, so now, or 90,000 units rather, no, 99,000, sorry. So a standard lot size has 100,000 units of the base currency. Okay, has 100,000 units of the base currency. So between 1.00 to 1,000.00, they are all standard lot size. Okay, anything having the figure on this other side of the decimal point is a standard lot size. Okay, so now we are going to be looking at the decimal place. Okay, remember our formula for finding our pp per dollar is the decimal place times lot size divided by the current market price. Sorry. So now the decimal place for non-Japanese pairs are quoted to 4 decimal place. Example, we have the 0.001. Okay, so for Euro USD, what I mean by non-Japanese pairs, I'm making reference to pairs that don't have the Japan, that are not paired against the Japanese yen. As we know, as we learned in the basics of forex, Euro USD, Australia USD, they are all quoted to 4 decimal places, right? So this is the formula. This is our one making reference to the decimal place. This is what we mean. Okay, we meant 0.001. Okay, so now the decimal place for Japanese pairs are quoted to 2 decimal places. We have the 0.001. Okay, we have 0.01. So this is the 2 decimal places, and this is 4 decimal places. Okay, so now we are going to solve. I'm going to show us how I arrive at the I'm going to show us how I arrive at these various values right there. Okay, so now for someone having the $20 account, your maximum risk per trade is 20%. Remember we said 20%, right? So that will be $20 times 20. Okay, divide by 100. If you remove this one, sorry, that will be 20 times 20 divided by 100. So you are risking $4 per trade. Okay, you are risking $4 per trade, and you are having a stop loss of 20 pips. Okay, you are having a stop loss of 20 pips. So value per pip, okay, that's the VPP on the Euro USD for someone having a $20 account. Okay, and you are risking $4 per trade. In other words, the maximum amount of money you are willing to lose from your capital is $4. Okay, so now the value per pip, how do you know the value of each pip? Okay, so remember we said decimal place. This is a non-Japanese pair, right? And it's quoted to 4 decimal places, right? So which is what we have here. So you just place, you will write so the decimal places will be in place of the, you replace the decimal place right here, okay? On the equation it will be 0.001, okay, times 2000, which is, remember, which is the maximum lot size we are allowed to use, okay? So the how I arrive at the 0.2 as the 2000 is that because remember 0.01, remember 0.01 is a micro lot size, right? And 1 represents 1000 units of the base currency. So if we have 0.02, that would be 2000 units of the base currency, right? So and the maximum lot size we are allowed to use is 0.02. So you replace that will be replaced, you write it in full right here, okay? So you write the value of the total units. Actually that's what you are writing here, okay? The total units is 2000 2000 units, okay? So divide by the current market price, okay? So this was a random price, so you will get your you have to look to the current price of that particular pair, okay? So let's say currently euro USD is at 1.13101. this is the pipette. Remember we said they are quoted to 4 decimal place, right? But this is the pipette and you just have to add it for completeness sake, okay? So you know what I'm trying to say right now is that for 0, the decimal place are the so when make reference to the decimal place for non-Japanese yen, they are quoted to 4 decimal place, okay? Then for Japanese years they are quoted to 2 decimal place. So for in this example we're having the euro USD, so that would be 0.001 times the number of units, which is the number of lot size, and we are using a micro lot size 0.02 as our maximum lot size. It could be, you can calculate it, you can as well calculate it with a 1 mini micro lot size, okay? That would be 0.01. So that would be 0.00 times 1000, okay? But we are calculating it at the maximum. I'm calculating everything here at the maximum. I'm using the maximum risk per trade percent, and I'm using the maximum lot size, okay? So your lot size should not be more than this, okay? So that's 2000 divided by current market price, so that will give us 0.17 cent per pip, okay? So each pip movement costs 0.17 cent, okay? So now multiply this by your stop loss, okay? So that will be 0.17 pip times our pips 20, our pips, our stop loss pips, which is our fixed stop loss pip, which is 20. So that will be $3.4, okay? So the total amount of money you are permitted to lose, the total drawdown you are permitted to lose, remember we are risking $4, right? But after calculating our pip per our value per pip, okay, we are able to arrive at the 20 pip stop loss we actually set aside as our maximum stop loss. We actually cost us $3.4, okay? So in this way you know that you are not risking more than your initial risk per trade, okay? So this is how you calculate, and you know that you are, yes, you are within the range of your risk per trade, okay? So that's how you calculate it, okay? So now for Japanese yen per, okay, we have the same thing. We have a $20 account, risk per trade 20%, okay? So that will be 20%, $20 times 20% divided by 100, okay? So that will be $4 per trade, okay? So now the Japanese yen tends to vary. Sometimes it's going to be lower than the value of the pips on euro USD, okay? So now we have, remember the 10 years are quoted to 2 decimal place, right? So we have the 0.01, okay, times how many lot size are we using? 0.2, a micro lot size, right? And that would be 2000, okay? So that would be 0.1 times 2000 divided by the market price. So I actually used the current market price of USD JPY on the weekend, okay, which was 1.28.414. so that will give us 0.15 cent per pip. So each pip movement cost 0.15 cent. Okay, so multiply by your stop loss, that will be 0.15 cents multiplied by 20 pips. So you are risking you are risking $3.1. And so if you take a close look on the Euro USD, we are risking $3.4, but on our on our Japanese yen USD JPY, we are risking $3.1, and it's still within the range of our risk per trade. Okay, so that is how you calculate it. That is how you calculate it easily. Okay, so same formula goes for the rest. Okay, I'm going to have to split this video into series. Okay, so I'm going to continue from the capital of $50. Okay, so watch out for the next series. Thank you for joining us today. See you next time.